It's been a long time since we had a streak like this. 14 out of 15 of the trading weeks ended up in the black or the green, we could call. The last time we've seen that happen was in the 70s, 71 going into 72. But Mike, what happens next? Well, in today's Stock Market Brief Show, where we navigate the financial markets through the lens of technical intramarket analysis, we'll be touching on what happened after that big rise in the 70s took place. We're also going to be touching on parabolic moves such as Nvidia and going back through history of other parabolic moves and what has happened after. But that's not all. We're also going to hop into what the difference was from the economic standpoint in the 70s and then also where we stand today. Let's get into it. All right, people, welcome back. I want to remind you in the pinned comment section below, you can download today's chart deck for free. I also have a link to the swing trading community. It is through Patreon, but I don't post on Patreon. I just use them as my billing stuff, and I sync Discord up to it, and you can link that up, $9 a month, or you pay annually and save some money. So this right here is the chart of the SP 500 in 2024, 2023, and then this was right here in the 70s, and has a very similar type run to it, right, where you see a nice big run up, a pullback, and then a nice big run, pullback, and a nice run here. And people were asking, okay, well, what really happened after that? So if we take a look here at the bigger chart of just in the 70s here, from that nice big run, it actually went higher, right? We saw some moments of volatility where it chopped around and price action continued to press up and away. We then had a subtle pullback into this area, and this is where things started to kind of come unglued. Now, back then, you got to understand that in the 70s, there was a period of stagflation. And stagflation is where you have inflation and unemployment, right? So inflation is rising, unemployment is rising. That's what you really see here going into the 70s. And then also right here is kind of where we're talking about where you saw those spikes leading into that gray shaded area, which was a recession. Also to note, we had the oil embargo from 1973 to 1974. Well, on top of that, we also had on August 15th, 1971, we had the U.S. temporarily suspend the convertibility of gold, of U.S. dollars to gold, which was basically the Bretton Woods system here. So what happened after all of this stuff? Well, you can see here in 1973, where we topped basically in January, we pulled down and we saw about a 50% drop in the markets. This was a big drop. It was one that we haven't seen for quite some time. It's pretty rare. The time prior to this was in the 1929 Great Depression, where we saw the stock market completely crumble almost 90%. Now, how long did it take for price action to recover this? Well, if you're here in 74, 75, we had this double bottom, and it took about till 80 to mid-80, 1980 to recover that. So about 8 years of, down, choppy side price action, and then we came back up here. So it can take a very long time to recoup those prices. Now, you might be saying, but Michael, we're at all-time highs right now. There's no way the market can fall. And you may be right. But also to note, in the 70s, right? 72, 73, where we peaked right here, that was also an all-time high. And if I look at this chart specifically, looking at the 10-year and 3-month yield curve, and we have a monthly chart of the S&P 500, we have an inverted yield curve, and there's been plenty times through history that when we are inverted, we also reach all-time highs before seeing these markets sell off, and we're basically hitting all-time highs with a very inverted yield curve. I also added the federal funds rate down here so you can see it's also during periods of rate hikes, and then we started cutting shortly thereafter, and then we uninverted and we started to see volatility. In 2008, we had the 58% drawdown, 51% drawdown prior to that. If you're wondering what this looked like in the 70s as far as the yield curve goes, well, this right here shows you that. This is from the Federal Reserve website. 1973 was right here, and we had a pretty deep yield curve inversion. Actually, if you just look to the right of the screen where we are, we're about as inverted as we were in the 80s, but then prior to that, also we had a very deeply inverted yield curve there in 1973. You might be wondering, okay, yeah, but there's no signs of a recession. Well, the Fed is actually saying that there's a 61% probability of a recession. That's in for 2025. But if you just look back a little bit over here, it's even a little bit higher where it reached up to around 70%. And you can see it's been pretty accurate as far as pricing in periods of recessionary times. And recessionary times typically come when you have a spike of unemployment. So back to this chart over here. Right? We talked about stagflation was rising inflation, rising unemployment. Unemployment is sitting at, record lows over here. And you can see inflation is kind of coming off. So we saw this rise over here, a pullback, and it went higher. Well, we've seen a rise, a pullback. Is it going to stud out here, or are we going to see a snap back down? I don't know. But if we do go into a recessionary time, it's likely we see unemployment tick up. It is interesting to note that a lot of companies are laying off people, but yet for some reason, unemployment's still down. So may need to take a stronger look into these jobs of what is being reported, but that would be for another video. Now, as far as the environment goes in today's macro environment, we are still in a tightening cycle. That is what the Fed is saying. Their fight is to get inflation down to 2%. Earlier in this year, early in 2023, in March of 2023, we had some difficulties, some cracks showing within the banking sector. And in the banking, the Federal Reserve started what's known as the Bank Term Funding Program right over here. And when they stepped in, you can see that actually markets responded quite well to that. Now, this is coming to an end here in March, and we'll see if this correlation all of a sudden dies off, right? We saw this move up, and the red line is the SP 500, and it recovered. We flatlined, we corrected. We moved up once again, and then we're starting to flatline here as well. If you take a look at bank reserves, also we're adding liquidity. Markets continuing to move up here too as well, but not quite to the same extent as we saw with the Bank Term Funding Program. If we take a look over here at credit growth, is it contracting? Is it not? Well, if you date back to the 70s, right, you can see that there's a period where credit growth contracted severely and it went negative from a percent change from a year-over-year perspective. And what you'll notice on this specific chart, every recession, what preceded it? Every recession right before it preceded a contraction in credit growth. Now, that does not mean that if you have a contraction, you're going to have a recession. Okay, that's not what this means, but it is interesting to note where we are now, and we're seeing credit growth being contracted from a year-over-year basis. You can see it drying up. But one other element that you can add into this is something like the 10-year, 2-year curve. So now I'm showing the credit growth contraction, and you're seeing the 10-year, 2-year curve in red. So if I date back to the 90s over here where we had the inverted yield curve, you can see credit growth was contracting. We had the inverted yield curve. When it uninverted, we started really kind of breaking down through the zero line there. Okay, and then if you go back over to here, same thing, credit growth was contracting. This was in 2000. Inverted yield curve, we uninverted, started going down, right? So it gave us insight, started going down, we were inverted, boom, and then it shot right back down. And even here in 2019, or as late 2019, where we had this very small yield curve inversion, credit growth flattened out to slightly go down, but this was kind of a one-off. So let's not really count this one. That obviously the pandemic took place there. And then where do we stand now? Well, we have a yield curve that's currently inverted. We have credit growth contracting. So is this going to flip to uninversion? And if it does, are we going to see this kind of contract more? Through the lens of this, it tells us that this could very well be one of those times where we have another gray shaded area or moving into a recession is what I'm picking up from that. Now, if we apply the federal funds effective rate to it, you'll see also during the rate hike cycles where we had the inverted yield curve, there's also an element of them cutting rates, and that's when it uninverted. And back to this chart, when we had the rates being cut, right, and the yield curve uninverted and started to steepening, that's when we started to see shortly thereafter the volatility in the overall markets. You might wonder, okay, but when are they going to cut rates? There is a probability that we're going to be cutting rates not in this next meeting, but the following meeting. When you look at in terms of the yield curve, of the two-year constant maturity, the 2-year yield, and you apply the federal funds rate right next to it, you'll notice that the Federal Reserve really kind of stops hiking rates when the yield curve, the 2-year crosses down beneath it. And when it crosses down beneath it, you can see we flatlined, and this kind of gave us a forward look on when they're going to start cutting rates. You can see it went beneath it, they flatlined, and then we started cutting. Okay, we went beneath it, flatlined, started cutting. And right over here, we went under it, we're flatlining. If this starts to head back down, chances are, as it stands, we're moving into the period soon where they might start cutting those rates. If we take a look from another economic standpoint where you look at, what are banks reporting as far as stronger demand for commercial and industrial loans, and this is both large all the way to small firms, and you can see we're actually at a negative level here from a percent perspective, and you can look back through the time, right? This happened over here just around the pandemic, back here in the great financial crisis, and back here during the dot-com bust, but we are starting to uptick right here, which is positive. Another thing that you can look at is just the tightening standards, and you can see here we're still fairly tight, but we're coming off a little bit. And you can see throughout history over here, dating back to the early 90s, we had spikes up here during the pandemic, spikes up here in 2008, and spikes up here during the dot-com bust. So this is not to say that the market is going to all of a sudden, get hit, but there are some cracks in the system, it seems like. Although, it's hard to believe that when you just look in terms of a stock market that has been going, obviously, setting records and closing at all-time highs. So I want to get into another aspect of this, and this is parabolic moves. So on a prior episode, we talked about Nvidia's, monster run up here. But if we compare it to Cisco systems of, 2000, the dot-com bubble, we had this 8-week consolidation and it broke out and went almost 121% higher. Well, we had this 8-week consolidation, we're breaking out, and right now this isn't updated, but price is more even higher right now. So we'll see just how far this can go. If I show you what kind of like a parabolic curve looks like, you can see we have multiple bases and it breaks and breaks and breaks and breaks and breaks into a point where it gets really exuberant. And if you take a look just here on the Nvidia chart on a monthly time frame, just dating back, all the way to 2010, obviously here, and this isn't a log chart, but man, this thing is just absolutely incredibly moving, where you have, small base breakouts, and this thing is completely just and utterly, it would be crazy to see this thing at, obviously 1,000, but it's not only that one. Take a look at super micro, right? It's SMCI. This thing has been on a monster tear too. And the reality here is these moves aren't sustainable by any means. There will come a time where it digests, where it pullbacks, or if it blows off. Now, I know Nvidia's earnings are coming up around the corner. So what we can potentially watch for is an earnings where if it gaps way up and then you get this big exhaustion move where it closes at the low of the day, that could be a potential blow off moment for Nvidia where it takes some time to recoup. Maybe, we don't know. But let's look through history of what some other charts like this look like. You can take a look at the tulip mania. I don't think Nvidia is going to zero, but you can see things get crazy euphoric, and we see these monster blow off moves. But it's not that. Take a look over here at the South Sea stock. This is from 1718 to 1721. And this was Isaac Newton's nightmare, right? Newton invested a little bit right here. He exited happy. Newton's friends, they got rich, so he re-entered in over here, and it blew off a little bit further, and then it completely went broke, right? And then he exited over here. And then you could also take a look at something like the price of gold, right? In the 70s, right? This was during the time, somewhere around the time over here, like we previously stated about Bretton Woods, gold had this parabolic run up, but then kind of the bubble popped, right? This is what happens on parabolic moves. Another one to potentially look at is the dot-com move of the NASDAQ composite. This thing had a parabolic run, right? And it came all the way up to the 5,000, 5,100, which is funny because the SP 500 just reached up to 50. Don't make any assumptions there. It's just kind of funny. And then we blew off, obviously. Now, what's interesting about this is this was like the dot-com, right? The internet bubble. And right now, people are talking about the AI bubble, right? You get a lot of semiconductors that have been moving like crazy. And the thing is, it's not like semiconductors are going to go away. Just like the internet bubble, it just gets a little over-exaggerated. Well, not a little, a lot exaggerated. Then it completely busts and takes a while to get back, but still is revolutionary technology. So that could be something potentially in the works right now, but we will only know that in hindsight. Now, this doesn't mean go short the market. This doesn't mean that we're going to have a similar look to 1973 and the market's going to fall, 50%. That's not why I'm doing this. I'm sharing this just because I thought it was a very cool analog and it looked good. And then I wanted to show some more macro data. Overall, when you take a look at the S&P 500, the S&P 500 has been doing exactly what the S&P 500 has been saying it's going to do, especially for the last 4 weeks. The last 4 weeks, we've been closing at the weekly expected move. Okay, we haven't been getting out of it. We've been closing on it, including this last week. We closed basically to the dollar on that level. So going into next week, we also have a $64 expected move. These are some fairly large expected moves that have been coming into the market. I don't know what the market necessarily sees, but what they do see has been more increased volatility. Okay, so overall, we're above a rising 5-day moving average on the 65-minute time frame over here. So if you are bearish, I don't know why you'd want this to start rolling over, right, in price to get, create a series of lower highs and lower lows so the trend could start turning around. As it stands right now, right, if it gets under it, be bearish but with caution, because it is still trending up at this time. It's only when this starts trending down when we have actually a short-term potential change in trend. And that right there can help protect us just in case if you're long Nvidia, right, and it starts coming down, right? If you catch the intraday moves and price changes from a smaller trend perspective, you may catch the larger trend changing. That's all I got for you on today's episode, everybody. Hope it helped out and gave you some information. See you later.